I'm Leandra Letterman.
And I'm Allison Christians.
And it's time to break into tax. This video is designed to pull together in one place the initial basis a taxpayer has in an asset across different contexts in which the taxpayer acquired the property.
Basis is important and relevant to the taxpayer in three phases: at acquisition, at a time when there could be an adjustment to basis, and at disposition of an asset. And today we're going to focus on basis at acquisition.
Basis and value are not the same thing. They sometimes are the same, or sometimes the initial basis is equal to the value, but then the numbers diverge because the adjustments to basis are not designed to track increases or decreases in value.
We're going to go through 6 different ways to get basis and talk about what makes it different for each of those different scenarios. Stay tuned till the end of the video to see the list of all the code sections we mentioned along the way. The first is the most straightforward. It's acquiring an asset by cash.
The second one we'll cover is a lifetime gift.
The third one is a gift at death, a bequest, or an inheritance.
The fourth one we'll cover is what's sometimes called tax cost basis, which is basis that reflects the amount the taxpayer included in gross income.
Then category 5 is the taxable exchange, commonly referred to as barter.
And the 6th category is a non-recognition transaction. In other words, a transaction where there's a realization event, but it's not taxable.
We can see we start from easy and get to pretty hard, but you're going to walk us through all that, so no need to panic.
Don't panic.
Okay, so let's start with the easy one. Let's start with acquiring an asset for cash.
So the initial basis in property acquired for cash is cost. That's Internal Revenue Code section 1012. If the taxpayer pays $100 for a painting, the taxpayer gets a $100 basis in the painting.
It's pretty straightforward, so we can get right on to the next one. Let's talk about what happens if somebody gives you something as a gift.
If the taxpayer receives property by gift within the meaning of Duberstein, so it was out of detached and disinterested generosity, then Internal Revenue Code section 1015 applies. The general basis that a donee receives is the donor's basis, increased for any gift tax paid on the gift, but we'll set that part aside. So in general, the donee steps into the donor's shoes. So if mom paid $100 for a painting and she gifts it to me for my birthday, I would take a $100 basis. That's the general rule. And that rule holds if the property has greater value in the donor's hands than the donor's basis. So if mom paid $100 for the painting and it's now worth $150, I take the painting with a $100 basis. But that allows potential shifting of gains from mom to me, because if I sell the painting immediately, the $50 of profit on that would be taxed to me. And the US tax law is fine with that, but doesn't like the idea of loss shifting in the gift context. So if instead, let's say mom has a $100 basis in the painting, but it's actually worth only $80 at the time that she gifts it to me, then I do take a $100 basis, but I actually have a second basis. I have a basis for determining loss on future disposition, and that basis is limited to fair market value. So my second basis is $80. So what ends up happening is I have a $100 basis for purposes of determining any gain on future disposition, and I only have an $80 basis for purposes of determining any loss on future disposition. So this is an example of where property can have 2 bases. It's not the only example of that in the US tax law, but it's an example that you might encounter fairly early on in your study of tax.
Well, we went from pretty simple to kind of complicated in one little step. Let's see what happens when we get to bequest and inheritance.
So the rule is actually quite a bit simpler, and that is the fair market value of the property at the time of the decedent's death. That's the basic general rule. So what that means is if someone passes away owning a painting that's worth $100 and I inherit it, I take a $100 basis in that painting. And it doesn't matter whether the decedent had a $150 basis or an $80 basis or $1 million basis, I get the fair market value at death. This is an exception to normative tax principles, which we'll come to later. It's a very simple rule. And what this does is it wipes out any paper gain or loss on the property. This is called a stepped up or stepped down basis. There is some pressure to eliminate stepped up basis at death. So it is possible that in the future, the US tax system will have something more similar to the gift basis rules.
Cash, pretty simple. Gift, a little more complicated. Bequest, inheritance, maybe a little less complicated in the grand scheme of things. Then we get to this tax cost basis idea, which has a few more wrinkles. Let's go through that.
So tax cost basis is the idea that the basis the taxpayer receives equals the amount of gross income the taxpayer had from the transaction. The classic baseline example is if the taxpayer performs services and is paid in property. So for example, the taxpayer employer provides a bonus, let's say, that's in the form of a painting instead of in the form of cash. And so let's say the painting is worth $100. Well, the taxpayer has $100 of gross income. That's based on Code Section 61 and the regulations under Section 61. Then as a corollary, the taxpayer takes a $100 basis in the painting. And here's why. What could happen instead is the taxpayer performs services for the employer. The employer provides a $100 cash bonus, and the employee says, gee, I really like that painting you have. How much is the painting? And the employer says it's $100, and the employee hands over the $100 of cash. And what happened? Overall, the employee performed services and ended up with the painting. And the actual economic positions of the parties are the same whether that cash transfer occurred or not. But had it happened, what we would see is that the employee paid $100 of cash for the painting and would get a $100 cost basis in the painting under Code Section 1012. So without that cash transfer, with the economic results being exactly the same, it makes sense to have the employee's tax basis also be identical and be that $100.
If you didn't do that, there's a risk of double taxation.
What happens if instead of your employer giving you the painting, you are walking down the street and you stumble over a beautiful painting? Same idea?
Yes, found property, treasure trove is gross income, and the same concept applies. So if the painting is worth $100, you have gross income on discovery, and you have a tax cost basis of $100 in the painting.
Okay, well, what about instead of stumbling over it on the street, you go on a game show and you get a prize of a fabulous painting?
Same idea. So prizes and awards are generally gross income under Internal Revenue Code Section 74. And again, the taxpayer's basis tracks that gross income amount.
Prizes, awards, found money, those are all income in the US. They might not be in other systems. So that brings us to the fifth category, which is the classic barter, this for that.
Yeah, and in particular, exchange of property for property in a taxable exchange. And a classic case in the US is Philadelphia Park Amusement Co. And in that case, the taxpayer exchanged the Strawberry Bridge for a 10-year extension of the taxpayer's railroad franchise.
One of those doesn't seem to be tangible. Does that matter if it's tangible or intangible?
No. And so the same rule applies to tangible and intangible property as long as what's being received is property. And the principle that comes out of that case is that the taxpayer's basis in the property received is the fair market value of the property received. Usually when people barter property, the properties are going to be of generally equal value, assuming it's an arm's length transaction. But it's possible that the properties have somewhat different value, and for whatever reason, the parties decide to go ahead with the exchange and not even it out. And so that's when it's really important to understand that the taxpayer's basis in the property received is the fair market value of that property received, not of the property relinquished. And the reason for that is parallelism with the tax consequences under Code Section 1001 in a taxable exchange. Having this rule prevents double taxation or under taxation. In instances like basis in a taxable exchange, where the basis in property is equal to the fair market value of the property, that requires knowing the value or having some approximation of it. That's actually a complex issue, and it's subject to a fair amount of abuse. We'll include in the description a cite to my recent article, Valuation as a Challenge for Tax Administration, in case you're interested in exploring that issue further.
Now we get to the sixth and final of our categories. What is the basis when you receive something in a non-recognition transaction?
In general, in a non-recognition transaction, the taxpayer takes some kind of historic basis, some kind of substituted basis that's determined either with reference to basis in property that the taxpayer relinquished in the transaction, or that's determined by reference to basis someone else had in the property the taxpayer received in the transaction. And it's usually adjusted to reflect a couple of general ideas. One is that the taxpayer's basis is adjusted upwards to reflect any gross income the taxpayer has to include, and this is a tax cost basis idea. Very related to that, although you see it less often in non-recognition transactions, is it would be adjusted downward to reflect any loss that the taxpayer was able to take. And then the second major adjustment is that the taxpayer's basis is adjusted downward for divestment. When I mention these adjustments in computing your basis and property received in a non-recognition transaction, I am not talking about adjusted basis. I'm still talking about computing the taxpayer's initial basis in an asset. It's just that there's a calculation that the Internal Revenue Code provides, and the specific code section will depend on which particular non-recognition provision we're talking about. In general, the principles are the same, that the calculation starts with a historic basis and then makes some adjustments upwards and downwards just to come to the taxpayer's initial basis in that asset. So in a non-recognition transaction, whether that's something like a like-kind exchange of real property or a corporate reorganization, the idea there is the taxpayer has a continuing interest in the same type of property. And to the extent that the taxpayer divested, either by receiving cash or receiving some other kind of property that's not the qualified property, not the property that's permitted to be received without the recognition of gain or loss, then that receipt of other property is also divestment. That non-qualifying property is generally referred to as boot. Not that kind of boot, but something else that the taxpayer receives to boot.
Could literally be a boot.
It could literally be a boot. Oftentimes it's cash,
Right.
cash boot, but it can also be something like a painting or a car or whatever. When boot is received in a non-recognition transaction, in general, it will get a fair market value basis. And there's an important principle that emerges here, which is, in general, if the transaction is taxable, the taxpayer gets a fair market value basis. We see that even with the simple purchase. So the taxpayer pays $100 for the painting, that's presumably its market value, that's the taxpayer's basis. We see it in the tax cost basis context. The taxpayer receives the painting in return for services, or as treasure trove or as a prize or reward, the fair market value is the basis. And in a taxable exchange, likewise, under the Philadelphia Park idea, the basis of the property the taxpayer receives is its fair market value. Conversely, if the transaction is not taxable, typically then the basis remains some kind of old basis and is not stepped up or stepped down to fair market value. We see that in the general rule in gifts, that the donee takes the donor's basis, and we see that in non-recognition transactions. Bequests are a huge exception. That's a violation of normative tax principles. As I mentioned earlier, the basis in bequests and inheritances actually is stepped up or stepped down to fair market value.
So we've gone through the 6 big picture ideas of basis in the US federal income tax system. We went from pretty straightforward to kind of complicated, but there's a rationale. I think at the end of the day, if you can just conceptualize that as things that you put in a beaker and hang on to it and keep track of it, I think it will get you on the right track. So if you missed any of the code sections as we were going through this discussion, fear not, they're about to show up next and you'll have them all in one place.
Thank you for joining us as you break into tax.